Welcome back, everybody. Now, today we're talking about everyone's favorite topic and the one that many of you all constantly tell me that I'm clueless on, and that's valuation. Now, if you remember, a few weeks back, I talked about how I'm not actually using price targets anymore and how I stopped using my discounted cash flows and multiples models, and instead, I'm using historical price ratios to see where a company's trading based on its own history. But there's an important aspect to this that I only touched on in the last video, and that's the integration of the growth rate into your analysis. Because as we know, the market is future looking and stocks generally trade based on how the market perceives their growth prospects or their overall strength at preserving and growing capital. And if this sounds familiar to things that you've heard in the past, that's because it actually is, and specifically the PEG ratio. Now, the PEG ratio is a pretty popular valuation tool, and it's used to compare the price to earnings to growth. And it was something that Peter Lynch talked about in his book, One Up on Wall Street, which, by the way, is a great book and one that if you're interested in individual stocks and you're just starting out, I definitely highly recommend. It's probably my favorite stock book of all time. And what he talks about in that book is right here. He says the PE ratio of any company that's fairly priced will equal its growth rate. I'm talking about growth rate of earnings here. And the example he gives is, if the PE of Coca-Cola is 15, then you'd expect the company to be growing at about 15% a year. But if the PE is less, then you might have found yourself an actual bargain, and if it's more, then it'd be unattractive. And then he says, in general, a PE ratio that's half the growth rate is very positive, and one that's twice the growth rate is very negative. Now, as with any financial metric and rule, I have to caveat it with, it depends. We should never take any of these rules just blindly as gospel. And actually, if you just look at the market right now, what you'll find is that a lot of these, quote, more stable companies aren't really anywhere near this measure. So if we look at Coca-Cola, it has a PEG ratio of 2.61 and a forward projected PEG ratio of 3.71. And that's because its PE ratio is at 25 and its earnings growth rate is just under 10%. And it's expected to be lower going forward at under 7%. Or if we look at Hershey's, which is one of the stocks that I sold earlier in the year, it has a PE ratio and a projected PE around 18. But when you look at the growth rates, you see that the year-over-year growth rate looks really good. But you have to understand that that's the trailing 12 months compared to the previous trailing 12 months. So it's taken into account a lot of previous quarters where the outlook was different. But if you look at their projected, it's much lower. So Hershey's was a good example of a combination of issues in terms of why I sold, because obviously a lot of what I talked about was the uncertainty around cocoa prices, and that definitely is a big deal because you don't really know when that's going to be resolved. But even if it was resolved, I had a concern with the level of growth going forward, because the question was, where was the growth going to come from? Because having a company with a good valuation but with no real growth usually equals subpar returns. At least that's how I looked at it. And you can see that in their valuation numbers, with their current PEG ratio being a very attractive 0.81, less than 1, meaning their growth rate is higher than their PE. But when you look at their projected PEG ratio, it's an extremely ugly 7.25. I mean, yuck. Now, obviously, projected growth rates aren't set in stone. They're not something that's guaranteed, and they change all the time. Because Hershey could come out in their next earnings call and say, hey, we're going to have 20% growth over the next year, and then all this would look attractive again. The question as investors is, we have to think about how likely that is to happen or why we think that's going to happen. Okay, so now that we understand the PEG ratio, I'm here to tell you that I don't really use the PEG ratio because, as you guys know, I generally like to use cash flows more than earnings. So what I created was basically like the PEG ratio, but with cash flows. I'm comparing the price to cash flow to the growth rate of their cash flows. And I'll just walk you through my extremely simple and basic spreadsheet, and then we'll talk about it. So as you can see, I have the ticker symbol on the left, and then I have 6 columns of data here that I get directly from Seeking Alpha, and I just plug in. Price to cash flow for the trailing 12 months, price to cash flow for the trailing 12 months 5-year average, price to cash flow projected, and all of these are actually operating cash flow, not free cash flow. And then in terms of growth, I take the operational cash flow growth year over year, the operational cash flow growth projected, and then the levered free cash flow compound annual growth rate over the past 5 years. And all these pieces of data are found easily on Seeking Alpha. That's partially why I'm using them. Because if we go to the valuation tab, my price to cash flow trailing 12 month is there along with the 5-year average. And then my projected price to cash flow is there as well. And then if we just go to the growth tab, you can see that the operating cash flow growth year over year and projected are right there. And if we scroll down to the bottom, you can see that the levered free cash flow compound annual growth rate is there in different time periods. And I just chose to use the 5-year. Now, the first thing you might notice is that not all of these are the same thing. Levered free cash flow growth is different than operational cash flow growth, and showing a price to cash flow is different than a price to free cash flow. Because free cash flow would include the impacts of CapEx plus, at least the way that I calculate it, stock-based compensation. But I didn't want to do that simply because I wasn't trying to create another super precise price target type of spreadsheet. The beauty of this spreadsheet is that it's very quick to update. I literally type in 6 numbers and it gives me an idea of what's going on. So I'm not trying to over-engineer this spreadsheet because for me personally, it's not really worth it. Now, for you, it might be, and that's totally cool, but all those pieces of data are simply there in Seeking Alpha. I can plug them in and get on with my analysis. But let's go ahead and take a look at what I'm calculating. Now, first off, I compare the current price to cash flow number to the 5-year average. And this is kind of like when I was looking at the chart to see where the price to cash flow is trading at. It simply tells me where the current price to cash flow is trading compared to their 5-year history. So in this case, Amazon is trading at a price to cash flow about 23% under their 5-year average. Now next is price to cash flow to growth for the trailing 12 months, where I simply divide the price to cash flow by the operating cash flow growth rate that's on the same timeline. And then I do the same thing for the projected price to cash flow and projected operating cash flow growth rate. And then lastly, I compare the trailing 12-month price to cash flow by the levered free cash flow 5-year compound annual growth rate. Now, in theory, it would be better to compare that growth rate to a price to free cash flow number if I had it readily available, but I don't, and I don't think it's worth the time to calculate, and I'll explain why later. So once I have all these calculated and I added some conditional colors just to help me see it quicker, but as you can see, Amazon has a price to cash flow that's lower than their 5-year average, and their price to cash flow to growth metrics for the trailing 12-month and projected look extremely attractive at 0.25 and 0.35. And then even their price to cash flow compared to the 5-year average free cash flow growth is still less than 1. And so just looking at it quickly, that's why I've been saying from a valuation perspective, Amazon still looks pretty good. And that's because the growth rate of the business is still outpacing the price of the stock. And then what I do is enter the same numbers for each of the stocks in my portfolio. And that's one of the ways I determine which of the stocks in my portfolio looks attractive right now. So when you see my list every month of here's my stocks I think are at the most attractive levels, this is what I'm using to determine that. And then I'll go ahead and update it maybe every week or every 2 weeks just to see how it changes as the price of the stocks change and as they report earnings. Okay, but what does this actually mean and how should we be using this? Now, if you watch this channel, you probably heard me say that valuation isn't a primary consideration for me. I tend to focus on the core business and how the business is being ran, and then I use valuation kind of as a secondary measure to see, is it trading in a decent enough range that I'm okay buying? And that's just my personal approach. I'm not saying it's what everyone should do. So when you see things like me using operational cash flow instead of calculating true free cash flow, that's why. I could do it, and I used to do it before, but I don't feel like the juice is worth the squeeze. So I designed this for convenience and being directionally correct instead of extreme precision. Because again, I think the key over the long run is more about picking the best companies than it is about getting the best price. And just to be clear, the reason I think that is very simple. If your plan is to be holding for multiple years, it's likely that any 10, 20, or even 30% drop is not going to be more important than finding the company that's actually going to compound at the best rate over that time frame. And I showed a very basic example of that in my previous video. But the other reason is that I think these value calculations and when analysts and other people say this is the true value of the company is misleading to new investors because they take it as this is what the company is actually worth. But that's wrong. That's simply what the company is worth to you based on the calculation and criteria that you have decided is important to you. Because remember, the market is actually a bunch of people buying and selling at different prices with different goals and different time horizons. So when you say this is the intrinsic value of the company, what you're saying is this is the intrinsic value of the company to me based on my criteria and the calculation that I created. Because some analysts use a PE ratio multiple to get to a target price, while others use price to cash flow multiples, while even others use EV to EBITDA multiples, while others use discounted cash flows or dividend discount models. So tell me, which one of those is the true intrinsic value of a company? And more importantly than that, which one is everyone else in the market using for that particular stock? Because like it or not, a stock is ultimately worth what someone else is willing to pay for it. So as investors, what we're trying to do is find opportunities to buy companies that we think are going to be worth more in the market over time. Because let's say you create the most beautiful valuation model and spreadsheet that ever existed, and it's totally unique to you. The challenge is, if no one else is using it or sees the stock value the same way, then what is it really telling you? And this is a simple point that I think is often missed when it comes to investing. Investing is just as much about understanding human psychology as it is about understanding numbers and calculations. And that's why I always say there's no alpha in a spreadsheet. Because valuation methods, in my opinion, should be used to get a directional idea if a stock is trading at an attractive level or not, but only after you've evaluated the business and understand what the opportunity is going forward. Because even in this spreadsheet, when we look at trailing 12 months and 5-year average growth rates, all of those are in the past, while the market is forward-looking. So yes, we have the projected growth rates in there as well, but the issue with those is that they're projected and not guaranteed. What our analysis of the actual business needs to do for us is give us an idea of how likely those projected growth rates are going to be, and that's something that each one of us is going to have a slightly different perspective on. We can't just look at a company like Nike and say, hey look, Nike's at $75 and it used to trade at $170. It must be a good opportunity. Or even that it trades at a 15 price to cash flow now and it used to be a 30 price to cash flow, so it's a good opportunity. Because again, look at the projected growth rates. Earnings per share growth of under 5, and operating cash flow growth of under 3. So the real question you have to ask yourself is, how is Nike going to get growth back? And if they're going to get it back, when are they going to get it back? Because yes, they're an iconic brand, but is this the start of a trend of lower growth for them going forward or not? And it's the same question for Hershey's or Starbucks. Because for me, it's not enough to say that they're a strong brand and they're not going to go out of business anytime soon. Staying in business is not the bar. The bar for me is beating the market and building a long-term income stream. So that's why understanding a company's growth rate in relation to their valuation is critical. And in my opinion, you can't really value a company without it, which is why I made this very simple spreadsheet to help me do it. Now, it's not perfect by any means, but it gives me some directionally correct information that I can use along with my analysis of the actual business to hopefully make better decisions. And let me know what you guys think of my approach down in the comments. I'm curious to hear what you guys are doing for valuation as well. Now, if you want to see my original video of why I stopped using price targets, go ahead and click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.